Hi there, welcome to Kneppy Invest, and welcome to another analysis video where I look into a company that is listed either on the ASX or the NASDAQ, New York Stock Exchange, or many indices around the world. In today's video, I'm going to be focusing on Pepsico. This is a company listed on the NASDAQ with a ticker code PEP. Now, one of the reasons I've decided to look into Pepsico is I did take a position in this company a few years ago, and I want to challenge my preconceived perceptions of this company. Now, my preconceived perception of this company was it's a quality stock. It's a quality investment that if I held for the long term, I'd probably get a pretty good return. So I want to challenge that particular preconceived perception because sometimes what we think, what we believe can be completely wrong. And I do think it's beneficial to challenge our beliefs and our thoughts at times. Now, my preconceived perception of PepsiCo as a quality investment or company is based off or was based off brand recognition. I thought everyone in the world knows about PepsiCo. They're also quite diversified. They not only sell drinks like Pepsi and other stuff, they sell a lot of chips and a lot of other things as well. In fact, if you go to their website, they do have our brand section, which goes through some of their brands like they Quaker Oats, Gatorade, Doritos. They also have Red Rock Deli, which is one of my favorite chips. Hummus, Pepsi, of course, Cheetos, that sort of thing. So they do or are quite diversified, particularly in the snack area. Another reason why I decided to take a position in this company was just based off the chart. Now, if you have a look at the long-term chart of PepsiCo, so we have a look at the weekly chart of this company and just put in the 200-week moving average, you'll notice over the long term, the share price has consistently been above the 200-week moving average. And I'm going as far back as the early 1990s, and only about 5-6 times during this period has a share price dipped below the 200-week moving average. And those have been pretty good times to buy a position in this company. And right now, the share price is actually well below the 200-week moving average. So there is a possibility that right now is a great time to buy PepsiCo based off the last 30 years. So that's another reason why I took a position in PepsiCo. And another reason, well, this is not a reason. Another thing I probably should have looked at is the financials. And I actually did not even look at the financials. I just looked at the chart, realized this company probably has a bit of a moat just based off brand, and I just completely ignored the financials. So in this video, I am going to focus mostly on the financials via FinChat, and I really want to challenge my thinking that this is a high quality investment and or stock company. So what I'm going to do now, the other thing I should mention here is there is a difference, in my opinion. I've been thinking about this a lot lately. There is a difference between a quality company and a quality investment and or stock. And the difference all comes back to valuation and growth. You could have the best quality company in the world, but if it is significantly overvalued, then it probably does not translate to a quality investment. But I also believe, and this is where I've been doing a lot of thinking, there could be, and PepsiCo could be this company, there could be a quality company that may not be a quality investment just because of a lack of significant growth. So we're talking about mature companies, and I hear this a lot. For instance, Telstra, CBA, BHP, well, maybe not BHP, but a lot of these really mature companies are considered to be quality stocks or companies. And I probably would not consider those companies to be quality just because of the lack of growth. So I do think there is a difference between quality company and quality stock, and I'm going to be focusing on that in this video as well. Okay, so let's get into it. We've already had a look at the chart. Share price has or is well below the 200-week moving average. So when we come to the valuation part of this video, that becomes very important. Now, in FinChat, you have a lot of these different things you can look at. I tend to focus, when I'm researching a company, I tend to start my journey looking at the revenue growth. And if I see a lack of revenue growth, that's an instant massive red flag. And in fact, there's a reason why it's the first thing I look at. Because if a company can't grow their revenue, how are they going to grow anything else? Now, a company could grow their earnings without growing the revenue by cutting costs or increasing the margins, but a company can only do that for so long. So the best way a company can grow over the long term is by growing their revenue. So that is one of the reasons why I look at revenue growth first. So after revenue growth, I then have a quick look at earnings per share growth. Now I tend to favor revenue per share growth. Unfortunately, in FinChat, they just focus on revenue growth, but then they also look at earnings per share growth. Now, in FinChat, you can have a look at revenue per share growth. I believe it's in the financials, ratios, and they do have a per share part of this. Yeah, there it is, per share. So they do have revenue per share growth. So you could have a look at revenue per share, but it's a little bit more convoluted. But for instance, revenue per share growth for Pepsi over the last 10 years has been 4.88% per year, which is a little bit lower than what I'm looking for in a quality investment. Yes, in a quality investment. So after I look at growth in revenue earnings, I tend to focus on margins, then return equity, return invested capital. And then I'll have a quick look at the valuation of the company. Also have a quick look at debt, so debt to equity, that sort of thing. I don't want to see debt to equity too high or too much debt in the company. And then I will focus on valuation, but valuation does not determine the quality of a company at all. There's no argument that the valuation of a company determines where a company fits in the quality spectrum. I look at valuation because valuation always matter, even for quality companies, because you don't want to pay too much for a quality company because then it does not become a quality investment. So I always have a look at the valuation of a company, focusing on P/E ratio. I might have a look at EV to EBIT, EV to EBITDA, free cash flow yield, that sort of thing. A lot of times I'll just focus on P/E ratio just because it's the easiest and it's most well-renowned. Most renowned? Yeah. Maybe not world-renowned, but definitely most people do know, most investors know about P/E ratio. And after that, I tend to have a look, also have a quick look at dividend yield, dividend payout ratio. Now, the reason I have a look at that is I don't want the dividend payout ratio to be too high. I don't want it to be anywhere more than, say, 50%. I prefer it to be about 20%, if at all. And the main reason behind that is because the higher dividend payout ratio is the less growth is a company is going to see moving forward, because they're paying out most of their cash flow or their profit, paying it back to the shareholders. And that's not a recipe for future growth. So also have a quick look at that. Okay, and in terms of return equity or return invested capital, I prefer those to be above 10%, preferably above 15%, but I will take a company that has a return invested capital above 10%. So let's delve into PepsiCo. Now, straight away, when I looked at revenue growth, I was underwhelmed, and that's probably an understatement. So over the last 3, 5, 10 years, which they do have in FinChat, we do see revenue growing, but it's a meager growth. So over the last 10 years, revenue has been growing at 3.3% per year. So why is there a difference between revenue and revenue per share growth, which is a little bit higher than revenue growth? And that's because the company has been doing share buybacks. I'm assuming that because if we go to their financials and have a quick look at shares on issue, you would notice that the shares on issue have been decreasing. They've gone from 1.448 billion in 2015 down to 1.372 billion in 2024. And I'm assuming they're doing share buybacks. That's why that's decreasing. So that is a way for a company to grow their revenue per share, even their earnings per share, is by doing share buybacks. And that's fair enough. A company can decide to do that. It's one of the capital allocation decisions a company has to make. What do we do with the profit, the cash flow we are generating? Do we seek more growth, or do we give dividends back to the shareholders, or do we issue a share buyback, which does create value to shareholders if you look at anything on a per share basis. So revenue growth over the last 10 years, 3.3%. Revenue per share growth, what was it, about 4.5% or something like that. Earnings per share growth, very similar to revenue per share growth at 4.7%. Now, these growth rates are a little bit underwhelming. I am looking for a little bit more than that. So these are slight red flags. Now, something I have not mentioned is something I always look at is the returns of a company. The returns a company have given the shareholders over the last 5, 10, 20 years. And for PepsiCo, those returns have been quite underwhelming as well. So returns relate to share price appreciation or depreciation plus dividends. So I always want to look at total returns. So PepsiCo, total returns over the last 5 years, 2.7%. Over the last 10 years, 6.6%. Over the last 20 years, 7.4%. So would you be willing to get a 7.4% return over a 20-year period? And for me personally, that is a little bit underwhelming. That's probably a little bit lower than market returns, which is another little bit of red flag. Now, another thing I looked at is if you had perfect timing with PepsiCo over the last 30 years and you bought at a low and then sold at a high, what sort of returns could have you got? So I looked at a long-term low, and that was February 2009. And if you held it for about 14 years and sold it at the most recent high, which was around about May 2023, your return over that 14-year period would have been about 13% per year. So for me, that is sort of like the maximum return you could maybe envisage moving forward for PepsiCo. 13% per year, which is definitely better than 7.4%. But if I was looking for the maximum return that I might get out of an investment, I'd be looking for well above 13%. I'd be hoping 30 or 40%. So 13% as a maximum return over the last 30 years is a little bit underwhelming. Okay, so we've looked at revenue growth, earnings per share growth, all underwhelming. What about margins? So gross margins are 55.1%. Operating margins 15.6%. Now, in isolation, these means nothing. I want to also look at how margins are moving through time. So we'll get rid of revenue per share growth or revenue growth or whatever that was. And we'll have a look at gross profit margin. So this goes back 10 years. This is all I can get with FinChat, unless I want to pay a little bit more. And the main thing I can notice here is that gross margins are fairly stable through time. They don't range all that much. So the bottom here is 53.3%, and the high back in 2019 was 55.4%. So gross margins going sideways. So that's not a bad thing. It's not a good thing. It's not a reason to call this company low quality or even high quality. The one thing I don't want to see is margins decreasing through time. That would be a really negative sign. Now, operating margins, what have they been doing? You could actually argue here that maybe operating margins have been dropping over the last 10 years, but then you could also say here and argue that operating margins have been rising over the last 2 years because they did reach a lower in 2022. So I see no issue with margins. So I'll give that, I suppose, a slight tick. Now on to return equity and return invested capital. Now, before I do that, I just want to talk about dividends. So dividend yield for this company is 4.1%, which is quite high for a company listed on the NASDAQ. So this could be, in a way, a nice little income play. And the dividend payout is 79.4%, which is probably higher than what I would like, what I am searching for in a company. So the majority of this company's profit or cash flow is going back to the shareholders as dividend, which actually means the company has less scope for future growth. And that is why the company's return equity and return invested capital are quite high, what you want to see, but the growth in this company is low because they are turning most of their profit and cash flow into dividends, so they have less to play with. So even though I do like their return equity and return invested capital over the last 5 years, return invested capital has been averaging 13.4%. Unfortunately, because of the dividend payout ratio, most of the benefits that you would see from a high return invested capital is not really there for this company. Another bit of a red flag is debt to equity at 2.6. So the company does have a fair bit of debt, $39.94 billion of debt. Now, the market cap of this company is $178.1 billion. So the market cap is quite high, but the equity in PepsiCo is a little bit lower than what I would have expected. So with that net debt of $39.94 billion, the company has a debt to equity of 2.6. Now, another thing is valuation. Okay, so I probably would consider PepsiCo to be a fairly mature company, not a lot of growth. In fact, you could even argue growth has been just above inflation. So I'd like to that to be a little bit higher. So in a way, I'd probably call PepsiCo more of an income play than anything else based off their dividend and lack of growth. And that's not the sort of company that I'm searching for right now in my investing journey. But what about valuation? P ratio right now is 19.4, and that is screaming more of a growth company, sort of a slower growing company, than an income company. So P ratio of 19.4 is suggesting the market wants a little bit more growth than what this company is giving. But if we have a look at the P ratio of PepsiCo, we can do that in FinChat as well. We go to ratios. And I like to have a look at the P ratio of a company or any other sort of valuation metric just to see if right now the company might be cheap based off the last 10 years of history. So we'll get rid of the operating margins. Now, sometimes you'll see little spikes either to below the average or above the average. And that could be because a lot of times there are one-offs in profit, and that can distort the P ratio of a company. So back in 2019, the P ratio of PepsiCo was 12.3, and that was probably because of one. You can see this massive drop, and you can see this massive rise in 2023. So there could have been a one-off in that as well. And in fact, at that point, the high in P ratio was about 40.9 or something like that, which would have been or seemed really ridiculous. Another thing you can look at is, say, for instance, what else can we look at here? EV to free cash flow. Now, sometimes you'll see also spikes in this, particularly if free cash flow. See, there's a massive spike in 2019 when it comes to free cash flow. And that's the problem with some of these valuation metrics. If there is one little distortion in one year, you'll see a massive spike. I also like to have a look at the free cash flow yield, and I don't think there is a bit of a much of a spike here. Free cash flow yield. Oh, there would be because no, there's not. I like to have a look at the free cash flow yield, and currently it's about 4%. That's actually quite nice, but it has been higher in the past. And when I say higher in the past, back in 2016 through to 2020, we can see the free cash flow yield dropping. But back in 2016, this company had free cash flow yield of 6%. That's a little bit more attractive than 4%. But we have seen it rising over the past year and a bit from about 2% to 4%. So that is a little bit more attractive. And has been some research that free cash flow yield is one of the most important valuation metrics. And if you had some sort of investing strategy that just focused on free cash flow yield and you just bought companies who had a higher than usual free cash flow yield, and when I say higher than usual, I'm talking about comparing their current company's free cash flow to its previous 10 years of history, then more than likely you will beat the market by a considerable amount. So there is some validity to having just a look at free cash flow yield and basing your investing decisions on that. And free cash flow yield of PepsiCo at 4.1%. If you go back through time, it's the highest it's been since 2019. And one of the reasons why it has been growing is because of the chart. And the share price has pulled back a fair bit from the previous highs. In fact, the share price has decreased probably about 33%, maybe even more than that, from the previous highs. Okay, so that's my look at PepsiCo. And yeah, so I have challenged my perceptions of this company. So I thought coming in, or when I bought some shares in this company a few years ago, I thought this was a high quality company. And that's without looking at the financials. And I would change my opinion on PepsiCo right now. High dividend payout ratio, fairly meager growth. What else? Yeah, those sort of things probably would sway me to be calling PepsiCo more of an income stock and not a growth company at all. And that would mean I would not consider PepsiCo to be a high quality company for me personally, based off my investing strategies. So I need to see a bit of growth for companies that I'm investing in for the long term. But if you're after a little bit of income, then PepsiCo could be the company for you. Now, if you have any questions, any thoughts, leave those in the comment section of this video. Otherwise, I'm not a financial advisor. If you need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.